Recent mortgage data from two of Canada's biggest banks are indicating that many homeowners are starting to feel the pain of rising interest rates. And this could mean big trouble for the housing market. A recent article was put out with data from RBC and TD that revealed some shocking data. And that's exactly what I'm going to be going over in this video. To start us off, RBC, which is Canada's top lender, revealed that as of July, 43% of its Canadian residential mortgages had an amortization period exceeding 25 years. This is a significant increase from the 40% the previous year and a mere 26% in January of 2022. This trend suggests that homeowners are opting for these longer amortization periods to reduce their monthly payments in light of the rising interest rates. But that's not all. CMHC, or the Canada Mortgage and Housing Corporation, is seeing much of the same, stating that the majority of mortgages in Canada, 60% to be exact, have amortization periods longer than 25 years. Several trends have emerged since the Bank of Canada started boosting its benchmark interest rate in early 2022. And after 10 consecutive increases, the key rate now sits at 5%. What they're seeing is that borrowers are adjusting to the new high rate environment through behavioral changes. One of those being taking a shorter term with a longer amortization in order to help reduce their monthly payments. People are really trying to reduce their debt service and costs in the short term, even though that means they're going to be paying their mortgage over a longer period of time. Something else to take note of is that alternative lending sources have become more popular as more people are unable to secure financing from traditional lenders, such as Canada's big chartered banks. Another trend that's emerging, and I think this comes without saying, is that more people are facing financial strain. We're seeing that delinquency rates on other products like car loans or credit cards are coming up significantly higher compared to previous years. However, it's a well-known fact that Canadians are some of the best in the world at making their mortgage payments, sacrificing pretty much every other form of debt in order to keep a roof over their head. And unlike homeowners in the States who have the ability to lock into a fixed rate for up to 30 years, Canadians don't have the same option. Most Canadian mortgages have options of fixed rates for 1 to 5 year terms, with 5-year terms being the most common, or they have the option to go variable, which adjusts with every central bank change. However, there are actually two types of variable rate mortgages. That is a static variable rate or an adjustable rate, which is also known as a floating variable rate. With either option, when the Bank of Canada changes the key lending rate, they're both impacted but in different ways. However, with a static variable, your payment doesn't change, only the percentage of interest versus principal you pay. And this obviously means as interest rates go up, you end up paying less principal and more interest. Conversely, with a floating variable rate mortgage, both your payment and the amount of interest you pay changes, with your amount of principal staying the same. So while the static variable rate mortgage helps people in the short term by not changing their monthly payments, it ends up hurting them in the long run because they're no longer paying the same amount of principal, which is one of the major reasons why we're seeing these longer amortizations. On top of that, if and when rates get high enough that the borrower is no longer even covering the monthly interest payments, they hit what is known as a trigger rate. At the point where principal is no longer being paid down, the lender is triggered to adjust the payment up so that the borrower doesn't end up underwater on their interest payment. Typically, when you hit your mortgage trigger rate, your lender will contact you to inform you about some of the different options that you may have. The goal is to make sure you avoid a situation where your payments fail to cover more than your interest. And essentially, most of the time you have 3 choices, and here they are. Number 1, you can adjust your payment. You can change your payment structure to make sure that at least some of your payment is going towards the principal portion of the loan. An example of this would be if you currently have a 20-year amortization period, you could extend that period to 25 or even a 30-year amortization. By doing so, you could keep your payment close to the same, however, you would have more of that money going towards your principal. But of course, this means your mortgage is being extended and it's going to take a longer period of time for you to fully pay off. Option number 2 is to make a prepayment. The trigger rate of your mortgage is dependent on the remaining balance of the loan. Making a lump sum payment can push your trigger rate higher. You could also increase the number of payments you make per month so that the money is going towards the principal. You would most likely have to adhere to your mortgage rules about how many extra payments you can make. So if you're not sure, make sure you reach out to your lender or mortgage broker to figure this out. And option number 3, you could switch to a fixed rate mortgage. Sometimes your lender may suggest or recommend that you switch over to a fixed rate mortgage without any penalties. When you do this, you can lock in at current market rates. However, while this strategy could give you relief in the short term, in the long term, it could end up costing you more and your payments could increase. Because of the lending structure we have here in Canada, it's led to increased payments for many borrowers, especially after the Bank of Canada hiked its policy rate by 475 basis points in under 18 months. Additionally, many variable mortgage rates have surged to over 6 to 7%, a massive increase from approximately 1.5 to 2.5% before the central bank's adjustments. And I'm actually one of those individuals who's been hit by this, unfortunately. My original interest rate was 1.55%, and now it's up to 6.3%.
Which clearly I'm absolutely thrilled about.
Interestingly though, there's been a resurgence of mortgages with amortization periods surpassing 35 years. Just last year, RBC didn't have any such mortgages on their books. Now they make up 23% of their portfolio. That's a significant change. On the other hand, TD reported that 48% of its Canadian mortgages as of July had amortization periods beyond 25 years, up from 35% the previous year. They too have seen a spike in loans extending beyond 35 years, which is something that's a little bit scary. Longer amortization periods leave some mortgage holders stuck and unable to get ahead financially. Delays in paying off your mortgage could cost tens of thousands of dollars, impact your savings, and potentially even your retirement. Because of what's going on, you're basically running full speed on a hamster wheel, but not actually getting anywhere. And this is a scary place to be. As for those who are currently shopping for homes or needing to refinance, many are unable to secure financing from the big banks, and they're now turning to private lenders. And in many cases, these private lenders are charging much higher interest rates. Most of the time where we're seeing this done is when those borrowers hope that they'll only need to take on these higher payments for a short period of time while they wait for rates to come back down, and then they can get their financing from the banks again. But there was many people who are banking on exactly this over the past year or two, but obviously we've yet to see rates come back down. I personally know several people, and I've also heard many other stories of people taking 1 to 3 year fixed terms with the hope that rates would come back down by the end of it. And well, we're just not seeing that, at least not quite yet. So this continues to put financial strain on people and could potentially do so for the foreseeable future. And let's not forget, this isn't even taking into account those who have mortgages coming up for renewal that are set to see a big jump in their monthly payments with the new rates. How that plays out is hard to say, but it's definitely something to keep an eye on. So where do we go from here? Well, in all honesty, it's difficult to say because we really don't know what the Bank of Canada is going to do next. We're still seeing record levels of immigration, with new reports coming out stating that by the year 2030, we could be 4 million houses short. But those same reports are also saying that they expect to see up to an 89% increase in home prices by the same year. So what do I think is going to happen for the remainder of 2023? Whether the Bank of Canada does end up choosing to increase rates by another quarter point or not, I don't really think this is going to have a major impact either way. It will have some sort of an impact from a sentimental and consumer confidence perspective, but in terms of borrowing power and actual financial strain, I don't think it makes much of a difference compared to where we are now. We are starting to see a little bit more activity coming out of the summer months and into September, which is typical. And generally what we see is a little bit of a buildup in inventory until about October, and then it comes back down as we head into December. The same goes for buyer demand. As many people are coming back off of their spring breaks, off of the final long weekend of the year and this amazing weather we've had, anyone who put their home search on pause or was waiting for the fall to get back and going has pretty much started to do so. So I don't really think the market is going to see any major changes to the upside or the downside for the remainder of the year. But what I can say is when things do turn around, they're going to turn around quick. And when that happens is really difficult to predict, but all I can say is that you don't want to get caught up in that. If you are considering upsizing or buying your first home, I think right now presents a great opportunity. One of the things I always like to touch on is for upsizers, even if there is a little bit of a lull and a pullback in the market, the price differential gap is always going to look better on the downside versus when the market starts going back up. And when you look at it from a holistic picture, even though you may be selling for slightly less than you would when things pick back up, you're going to be saving substantially more on your next purchase. As for those who are downsizers or selling off investment properties, it's probably not the best time for you to sell. And if you can hold on until the market starts to pick back up again, this is probably going to be a better time. But if you are under financial strain right now and you're finding it difficult to make your payments on a monthly basis, I would suggest getting your property on the market prior to the end of October, and more specifically, as soon as possible. So to conclude, I don't think we're going to have a very exciting fall. Not much is going to change in my opinion, but what do you think? I'd love to hear what you have to say. Leave me a comment down below. And if you did enjoy today's video, all I ask is that you hit that thumbs up button so the algorithm will push it out to more amazing people just like yourself. And if you want to see more videos just like this one about the BC and Canadian real estate market, as well as community tours across the Lower Mainland, I suggest you consider subscribing to our channel as I put out new videos every single week. Lastly, if you are considering buying or selling in Surrey, Langley, or any of the surrounding cities for that matter, or you just want to chat about real estate, you can scroll down to click the first link in the description to book a call with me at a time that works best for you. Thanks so much for watching. Before you head out of here, make sure you check out another video on our channel, and we'll see you in the next one.